Welcome to Analyzing Finance with Nick. In today's video, it's going to be a culmination of several economic futures videos we've done on previous countries and recent developments going on in the eurozone economy that have kind of drawn me to a dire conclusion. Is Europe on the verge of becoming third world? Is the death of the European model of prosperity really coming upon us now? I'm going to attempt to answer these questions and explain what is going on and why is Europe's prosperity falling relative to other developed nations, particularly the United States. And without further ado, let's get started. As I did mention, I hinted at this problem in our videos about Greece, Portugal, France, the UK, and Spain. I also probably eventually will do a video in the future about Germany's voluntary deindustrialization and how that came to bite them a bit with the rise of the current conflict in Ukraine. And the culmination of all of this is really just that the European model is, and the European dream by extension, is expiring. It relied on three key tenets to keep it going. First, it was geopolitical stability, the combination of having the U.S. as its guarantor of defense and a stable eastern border with Russia, who's been historically one of the gravest threats to Western Europe really since the formation of the first Russian Empire. The second key component here is continuous innovation and a stable demographic of young, educated people to fill the roles needed in a modern economy. The third tenet really is that there was enough wealth from previous generations to successfully redistribute and to keep social balance, and to also ensure that the welfare state stays afloat. The European welfare state wasn't really just an act of magnanimous kindness from the European elites. As I mentioned in my video I did about the class structure in Europe, most of Europe is structurally lower middle class with a few old money who basically created the welfare state as a means to fend off revolution, which was a problem starting with the French Revolution in 1789 and really kind of crescendoed with the revolutions of 1848. The way to prevent further revolutions like in the 19th century was to make life comfortable enough and the perceived inequality gap that was structurally built into the system to be as stable and invisible as possible. Now, with Europe falling behind economically to other parts of the world, it's been harder to keep that illusion up. Let's start with GDP per capita. From 1980 to about 2010, GDP per capita in the United States, Canada, Australia, New Zealand, Japan, and the European Union kind of moved in lockstep. The US had a slight lead for most of that history. However, a lot of European countries such as Germany and the Netherlands and the UK caught up when the euro was particularly strong in 2006 and 2007. And the pound was particularly strong in that era too. But in general, on a currency adjusted basis, the US had maybe a slight lead, but the margin really never widened. And in fact, you could argue that a lot of the countries in Europe were catching up to the US in terms of global living standards and GDP per capita. However, really since the great financial crisis, this has diverged greatly. In 2010, the US GDP per capita was $50,000 US dollars per year. Netherlands was slightly higher at about $55,000 a year. Germany was in the mid 40s, and the rest of the major Europe, UK and France, were about $40,000 a year. And Spain in 2010 was a little bit over $30,000 a year. And in 2010, $30,000 a year in those dollars was about like the line between a developed economy and an emerging economy. Since then, the U.S. economy has continued to grow. Is now the GDP per capita of the U.S. is over $75,000 per year, and meanwhile, the GDP per capitas in Europe have all flatlined or declined in the same period of time. And you would say, well, how much of that has to do with currency? So, well, if we look at 2015, which is where, as I'm recording this, the euro was trading at the same exchange rate in 2015 as is today. And 2015 is really when the spread really started to widen. Currency is a wash because you've seen this divergence despite the fact that currency effectively is in the same place as it was 8 years ago. So that's what I originally thought when I looked at this. Oh, this is just a product of a strong dollar. But even on a currency adjusted basis, the US is lapping up the European Union and the UK. And it's not just the US. Canada has gained relative ground against the EU. So has Australia. So has New Zealand. And even Japan, to a certain degree, has as well. And along with South Korea and Israel and really effectively the rest of the first world nations. So, and then if you look at not GDP per capita, but annual wages, the Wall Street Journal had an interesting piece about Europe getting poor that came out on July 17th. And they have this chart that shows that U.S. wages have continued to climb higher since 2008 and 2019, whereas European wages, on the meanwhile, are down overall since 2019. In many countries such as Italy, Spain, and Greece, they are still lower now than they were in 2008. And this is all adjusted for inflation and purchasing power. If you look at the overall cumulative GDP, the Eurozone and the US GDP was roughly in line in 2008. And now in 2023, the US GDP has climbed up to about 27 trillion compared to just 15 trillion. So it's an 80% gap now between the size of the American economy and the size of the whole Eurozone economy. So what is going on here? Why is Europe continuing to sink and decline? I think a lot of it is because of those pillars I mentioned are breaking down. The first one is really the sustainability of the European social model. Countries as a whole have racked up much higher debt to GDP ratios than the US. As a result, you had a debt crisis in the early 2010s, and effectively, the ECB has had to respond by keeping interest rates much lower than they would be in an economy with far less debt but the same amount of economic growth. You see the chart below, the comparison of the ECB deposit rate and the effective federal funds rate since 2014 when the ECB decided to pursue QE has been quite telling. Interest rates were negative in the Eurozone from 2014 to as late as 2022. And meanwhile, they missed out on the whole tightening cycle that the Fed had in 2018 to the pandemic, and they are lagging far behind the US in terms of tightening monetary policy post-pandemic. And this is despite inflation rates actually being higher in the Eurozone and inflation falling a lot slower. And even the ECB's inflation is also is more exclusionary of the impact of housing markets than the American form of inflation. So if you factored that, it could possibly be much higher, the inflation in Europe. But despite this, the interest rates are much lower. So why can't Europe raise rates to deal with inflation? They can't raise rates to deal with inflation because of how sensitive their government bond markets are, particularly those in Italy. And so as a result, they have this dilemma between protecting the bond markets of the member states versus fighting inflation, and they have to prioritize protecting the bond market. And so that results in structurally higher inflation in Europe relative to economic growth. It also means that interest rates are effectively lower, which makes it harder for savers in Europe. And when there is a surge of inflation due to the economic stimulus or the macro drivers in other parts of the world, like that happened as a response to the pandemic, they just can't respond. And so as a result, the European people just eat it through lower living standards. And we have seen as a result of this reaction function as part of the driver why the euro has remained relatively weak, and why also European living standards have declined considerably. It's not as bad as it was at the peak of the Ukraine conflict when energy costs were up to 20% of disposable income. But it's still, basic needs as a percentage of disposable income are much higher effect overall in the Eurozone versus the United States. And that's not even factoring in how higher tax brackets kick in at much lower incomes than the United States, which I'm not going to factor in this analysis because the other side would say, oh, well, Europeans don't have to pay for healthcare. So I'm going to consider the higher taxes in healthcare as a net wash, whether that's accurate or not. Europe also, its percentage of global GDP has declined from 30% in 1980 to under 15% today, and its share of global exports has also declined by an even greater amount. So if Europe is losing its export powerhouse status, and that's compounded with certain green energy policies in some of the European leaders, such as Germany, who have made their industrial base less competitive, which I may elaborate on in a future video, that along with an aging population and not being able to replace retiring older Europeans with younger, equally skilled Europeans has caused the economy to be less competitive and less efficient. I'm not going to get into the demographics story here because that's been oft repeated, but Europe's demographic profile, I think, is partially driving why their living standards are struggling. And the reason why Europe just simply can't cut spending to reduce the government debt like they tried to with the so-called austerity measures is because the whole European social contract is dependent on this more work to live ethos, and that everybody can have this cradle to the grave social protection, which is simply not the case in other developed economies to the same degree. And trying to take that away will just cause a lot of social tensions, and that may be the end game of this. The other counter argument would really be, well, what about tourism? Can Europe be saved on the backs of tourism? Well, as I mentioned in the Greece video, tourism is not a solution for a first world economy. If you look at all of the top economies in terms of tourism as a percentage of GDP, they're mostly either Caribbean islands or Thailand or the Maldives or other countries that do not have the similar living standards that European population has come to expect. And even within the EU, the countries with the highest dependence on tourism, Greece and Portugal, rank among some of the poorest countries in the Eurozone. So, and also the ones with the worst debt problems. So I think tourism is really not a viable solution. Though Europe needs to create more value through exports of goods and services, or have a strong enough domestic consumption base of accrued wealth to keep a first world living standard going. If they do not do that, they're going to continue to sink. The other pillar that is at risk is geopolitical stability. The U.S. has been a guarantor of defense, and that has helped prevent any sort of geopolitical shakeups with Russia. who's been there historically the greatest threat to Europe in the post-World War II world. And as a result, Europeans did not have to invest in their own defense, or investors never had to get concerned about geopolitical insecurity. And so as a result, that money could be reallocated to either growing economic growth and development or to the social welfare state. Now, with the Ukraine conflict, no matter which way it goes, either you're going to have a chaotic state in Russia, which provides its own set of risks, or even if it's a peaceful weakening of Russia and they're never a threat again, then that may mean the U.S. may feel comfortable enough to pull out of its role as the guarantor of Europe's defense. And if there's the other way around, Russia gets stronger due to this conflict, then Europe's also going to have to bulk up its own defenses to accept that new reality. So in any of this possible scenario, this probably it breaks the pillar of stability and the lack of need to invest in defense. And so with that, the European Union also is at risk of handicapping what resources that previously could have been used to maintain social stability or economic development. So then how do we measure this? Because I can go on and say, oh, I think Europe is sinking into emerging market status. But there's got to be a way to try to quantify that. And the way I attempt to quantify this is I look at what is historically the standard of being a developed nation. And when I started studying development economics, the benchmark really in 2010 was a country with a GDP per capita of more than 30,000 US dollars per year in 2008 or 2010 dollars, which I'm going to be generous and use 2010 dollars for this, was the benchmark of being a first world, fully developed, rich country. And so with a lot of inflation, though, $30,000 in 2010 is not buy a lot more than $30,000 does today. So if we adjust that number for inflation, $30,000 in 2010 is $41,232 with an average inflation over that period of 2.5%. So if $41,200 is the benchmark for a wealthy country, then the European Union's GDP per capita as a whole, as of 2023, is only $39,940, which puts the EU on average in emerging market status. Other notable countries that now are out of really the club of truly rich countries that used to be there include Malta, Italy, and Spain, and Portugal, and Greece, and Slovenia have all fallen below that tier, or just really never made it above that tier because inflation rose faster than they can get above the 30,000 mark. You look at France at 44,000 is really only less than 10% above the cut line, and the UK at 46,000 is not that much higher. The most prosperous of the major economies in Europe is Germany at a little under $52,000 per capita. And then Belgium and the Scandinavian countries, the Netherlands, are well above the mark. US by comparison is 80,000, and Canada by comparison is 52,000, which is above Germany. Australia has also risen up to 65,000 GDP per capita, which is well above European rivals. And New Zealand at 48,000, which it used to be well below even the likes of Italy, is now moved above all of these. So the point I'm trying to make is that it's not just my American criticism, the fact that Europeans don't drive SUVs or live in apartments over single family homes is the explanation of it. I'm using more of an objective benchmark in terms of GDP per capita based on the traditional benchmark of development economics for what is truly a rich developed nation. and it doesn't look good. Does that mean that Europe is dead? No. But does it mean that political instability in Europe is more likely and economic growth is going to continue to struggle as Europe's demographic transition continues? Yes, it does, because people it's very hard to ratchet down living standards. And the inability to deal with this is what is the root of political populism all around the world for this kind of problem. And I don't think Europe is going to escape it. We've seen it recently with protests in France and the rise of populist parties throughout most of the continent. Let me know what you think. If you like this type of content, feel free to like and subscribe and share. And if I'm wrong and I'm misinterpreting this data and what my findings are, I would love to hear your arguments in the comments, because I would like to be wrong, and I'd like to see Europe go back to being a wealthy, prosperous place and not suffer from what I think is likely going to be a tenuous rest of the decade and beyond for them. Thanks for watching.